Did you know that 7.7 trillion of U.S. bank deposits are totally uninsured? That's 43% of all deposits just hanging out there unprotected, like it's no big deal. And most people think because the FDIC insures up to 250,000, that's enough cushion to protect them if something goes wrong. But according to last year's report, there's only 121.8 billion in FDIC funds available to cover depositors. After the collapse of Silicon Valley Bank and Signature Bank, you'd think we've learned our lessons by now. But nope, these uninsured deposits keep growing. At the same time that the unrealized losses of the big banks is over $517 billion in potential losses that the banks are sitting on. Sure, the FDIC stepped in last time to save the day, but don't get comfortable. The creation of the Federal Reserve BTFP program ended back in March, and that was a one-off emergency measure, not a standard. So why isn't anyone talking about this? Maybe it's time we start. All right, hope all is well. I want to take a quick minute and share with you an interesting article that caught my attention that might have fallen under the radar in reference to the current conditions of the depositors in the banking system. And so right now there's a lot of concern about what's happening on the banking scene, especially with those unrealized losses that I mentioned in the intro. But more importantly, it's the uninsured depositors that a lot of people may not be concerned with, just because if you're not one of them, then it's not something that really concerns you. But as of now, the funds that are in the bank continues to climb, and they're going beyond that threshold of $250,000. And so what we learned from the SVB Bank and Signature Bank is that a lot of the panic was set around the fact that people deposited funds into accounts well beyond the insured threshold, which led to the emergency measures that we got as far as the BTFP and things of that nature. But since then, things have gotten a lot worse. But then again, the depositors' funds continue to climb. So I want to share with you a couple graphs and whatnot and get your thoughts on it. As always, if you guys want to see more of these short, quick takes, hit that thumbs up button. Leave a comment down below and share your 2 cents on this matter. And also support the channel by sharing it so more people can find out what's really going on here. But as you can see on the screen here, this is the article here. FDIC report reveals alarming 7.7 trillion in uninsured bank deposits. And real quick here, it just highlights one of the key points from a report that came out last year. But it says here, the FDIC unveils some startling figures that shows Americans are holding a colossal 7.7 trillion uninsured deposits. And then it gives a quote here from year 2009 through year end of 2022. Uninsured domestic deposits at the FDIC institutions increased at an annualized rate of 9.8% from 2.3 billion to 7.7 trillion. And so from that information right there, it lets us know that depositor bank accounts were already growing well before the current events unfolded. And that has everything to do with the fact that we were in a ZIRP, or in real terms, negative interest rate environment where credit was cheap and the spigot was turned on and fractional reserve lending was basically tenfold, resulting in an economic boom or growth that was literally artificial in nature. And so therefore, everyone would seem to be making money. And the funds that they made end up going back into the bank deposits, leading to this artificial increase in depositor funds. But I find this to be a big red flag that the FDIC just recently made this announcement that amount of money of bank accounts are unprotected. So to some, it might look like just another big number in a big sea of data at first glance, but this one stands for about 43% of all domestic accounts. So what that means is that could be a huge amount of money that could be lost in another banking crisis, because we know the FDIC has nowhere near that amount to make anybody whole. That's why the Federal Reserve and the Treasury came together for that last emergency measure that they passed. And given the economic times we're in right now, you'd have thought we learned by SVB and Signature Bank going out of business. So if I was one of those individuals that exceeded that $250,000 mark, I too would be concerned, because we're not in the clear yet. And the whole part of that insurance scheme is the fact that it's the FDIC's job to protect depositors' money by insuring up to $250,000. And that seems like a lot until you think about how much money is left in the bigger accounts that isn't safe. And so what's obvious is the fact that the number of these uninsured accounts have been growing slowly, and the FDIC clearly is worried, especially about how many of these funds are in the biggest banks. And as you can see here on the screen here with figure 2.3, this is the demand deposit share of domestic deposits and how it's increased across all the banking sector. And so the light blue line at the very top here is the top 1% of banks. These are the GSIBs, the Goldman Sachs, the Morgan Stanley, things of that nature. And then the top 10% banks will be those mid-tier regional banks that are hemorrhaging right now from the commercial real estate issues. And they too have also seen an increase, especially following the pandemic stimulus that came about. And then you have the dark brown line, which are the majority of banks that we see throughout the country that the average person tend to bank at. And then here's another graph here. The share of banks with more than 50% uninsured deposits is increasing across all bank sizes. And what's most notable is the top tier of the GIBs, where this light blue line here, ever since QE began back in the 2011-2012 timeframe, the too big to fail banks' deposits appear to be gone parabolic in nature, surpassing the top 10% as well as the bottom 90%, where the average person is at down here. And why is that? The small savers, the average Joe and Jane, are protected when things go bad, while large amounts or high net worth individuals are at a much higher risk. See, in the past, savings that weren't protected have grown at a very scary rate. According to a lot of the figures there, they appear to have grown about 10% per year since 2009, when demand accounts were about 415 billion or so before the QE process began. And of course, for those who may not know, demand deposits are accounts that you can actually go in and withdraw cash in real time without having to wait for any length of time because the cash is readily accessible to the depositor. So as you can see, from 2009 onward, about 10% per year seemed to be the norm for demand deposits until we got to 2020, where it went from 1.4 trillion up to where it is today at $5.2 trillion. That's almost 15 years of growth that hasn't been stopped. And even though last March of 2023, when SVB and Signature Bank went belly up, the powers that be stepped in to make sure that those high net worth individuals were made whole. So it's times like that where the government had to step in and protect both the protected as well as uninsured savings. So with that being said, that was a one-time event. And one thing you can guarantee, the next event will be too massive for the government to step in and make everybody whole. So there will be major losses being taken by somebody. And unfortunately, it always seems to impact the average Joe and Jane. And what's bad about this is that how easy it is for the average depositor to think that the FDIC's role in stepping in for the SVB failure is now going to be a new standard, and not realizing that the government used that emergency measure to cover all accounts because of their concern for a systemic event. It was an unusual measure. And so since then, people have forgotten that by putting your money in the bank, while things are calm, it can appear that everything is safe and secure. But today, the fact that more than 40% of U.S. banks accounts are not insured by the FDIC should be a high enough figure where the depositors beneath the threshold of $250,000 should also be concerned. Because there's no way that when the next banking event happens, the Federal Reserve will allow those that are not protected to take all those losses and they not pass it down to the average person who may only have a couple thousand or a couple $100 in their accounts. Everybody may be locked out. And if that does happen, that'll be the ideal condition to really reboot the banking system and begin issuing whatever it is they have already ready and operating on their side right now, which of course we have all indications where either from the Biden-Harris side, it's going to be a CBDC. And if it's on the Trump side, it's going to be a USD stable coin type of mechanism, which I mentioned before in the previous video is all one and the same, centrally controlled, traceable, and trackable in real time. So these are subjects I think more people need to spend time talking about or even considering, because now we're in an environment where at the same time demand deposits have increased, the actual commercial banks themselves have been hemorrhaging losses. And if you go to the other side of this chart here, that small circle there is the damage that was done during the 2008 crisis. And so right now we're way past that. So we're literally in uncharted territory. One thing I can guarantee you that if the banks go down, everybody goes down with them. But then again, the system is designed to keep the banks propped up. And so the banks will be fine at the end of the day. It's just the depositors, i.e. uninsured creditors, that will be on the hook. And so right now with all this Fed talk about cutting rates, that could save off the banks a little bit because these unrealized losses is because of the tightening policies that have left a lot of these securities in the negative territory because of the higher interest rate environment. So if the rates do come down, then perhaps some of these losses can trend back up and turn into gains for the banks. But then again, that's all barring any type of unforeseen event between now and the time that environment arrives. So I just want to take a minute and share some thoughts and of course put together all these graphs and visual aids to let you know what's really going on and what needs to be talked about. The entire monetary system hedges upon the bank's health because the banks are the primary shareholders of the central banks. And the tool being used to keep the entire system propped up happens to be the currency. And that's what all this is about. So anyway, curious to hear your guys' thoughts. What do you think? Definitely be interested in hearing your take on these matters. So feel free to drop a comment down below. And as always, looking to do more of these short takes just to grab a hold of information, decipher it, and give it to you guys and let you guys make decisions accordingly. But as always, the banks will be banks and banksters will be banksters. And so if you know what they're doing, you know what their plans are, hopefully you are able to work around some of their maneuvers and realize that it's because of the currency, whether it be paper or their digits on their ledger, that's how they're able to manipulate the masses so much. So to limit the risk on you as well as on your family and your future, if you dial back from playing inside of their arena, you'll limit a lot of the risk that falls on the average person who have no clue as to how the whole system operates or how their funds in the hands of the banks don't actually belong to them. So at the end of the day, get your weight up. Insure yourself against your government, the banks, and your currency because you're responsible for your own financial future. But anyway, I'll catch you guys later. I'll see you soon.